As we get to the end of 2024, I think it's important to look at Rivian and where the company's cash position is and what we should expect for 2025 and then 2026. Remember, it's 2026 that the business should really start to be very different than it is today. The R1T and R1S are of course going to continue, but R2 and R3 are expected to start production sometime in 2026. And that's also when the Georgia facility is at least partially expected to be open. But the real challenge for Rivian short term is going to be cash. Do they have enough cash to get to the point where they can open that Georgia facility, launch R2, launch R3? Yes, they have this agreement with Volkswagen, but the company only has about $1 billion, and that is debt currently on the balance sheet from that deal. So I want to get into all these details and the trends that we need to watch with Rivian, because those operating expenses are going to be really key for the company going forward. And I'll get to that in just a second. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. I want to start with that VW deal. This is the announcement that Rivian and VW were going to work together on this joint venture to create industry-leading vehicle software technology and their strategic investment. Now, the number that gets floated around a lot is this number right here, $5 billion investment. That is not $5 billion that was just immediately given to Rivian to help grow their business. $1 billion was invested in Rivian. But you can see right here, $1 billion is invested in Rivian through an unsecured convertible note, so debt, that will convert to Rivian's common stock subject to certain conditions upon the latter receipt of regulatory approvals and December 1st, 2024. Volkswagen is expected to invest a further $4 billion as part of the transaction. What is that $4 billion? The additional investment of $2 billion in Rivian common stock is expected to take place at two tranches, $1 billion each in 2025 and 2026, priced based on basically the average price of the stock at that period of time. And the investment of $2 billion is related to the JV. So that will actually go to the joint venture, not to Rivian. So $3 billion is actually going to Rivian, $2 billion to the joint venture. But let's look at the balance sheet, because this is ultimately what's most important for Rivian. They had, at the end of the most recent quarter, second quarter 2024, $7.9 billion worth of cash on the balance sheet. That is the correct number. This $5.5 billion includes that $1 billion convertible note that Volkswagen has. Now, that could convert to stock, which would then be dilutive to shareholders, but it would reduce the amount of debt that's on the balance sheet. So you can see the trend here. Volkswagen had $18.1 billion worth of cash after they IPO'd. They have been burning through cash at an extremely rapid rate. They've been selling stock. They've been raising debt. This recent deal, short term, actually increased that debt to $5.5 billion. But what they need to do is get to cash flow positive. They need to stop burning cash. These two numbers in yellow, you see cash from operations. So that's not including capital expenditures. That's not including the upgrades to the Normal, Illinois facility that have been going in this year. Doesn't include anything in Georgia. That is just operating the business. They are losing $4 billion per year operating the business. That's where that $7 billion that's on the balance sheet, it doesn't last you very long when you're burning this much cash from operations and building out another facility. The $5 billion number is free cash flow. So that does include capital expenditures in there. You can see where Rivian needs to raise more cash. The $7.9 billion worth of cash on the balance sheet at the current run rate is not going to get them to the point where they can launch R2 and R3. Yes, they're expected to be improved operations later this year, should be a little bit better margins, but we're nowhere near being anywhere near cash flow positive from either an operating standpoint or a free cash flow standpoint. And what's the reason for that? This is the thing that I think investors need to focus on, is operating expenses. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. This chart shows operating expenses since 2021. These are annual numbers, and then I have overlaid the number of deliveries that Rivian has made in each of those years. You can see that over the past 12 months, 57,000 vehicles delivered, $3.8 billion worth of operating expenses. That means that right now, operating expenses account for $67,000 of each vehicle sold. That is completely unsustainable. But think now about Rivian's business in the future. They potentially have capacity to make 400,000 vehicles once they do the upgrades to the Normal, Illinois facility and they build out the early phase of their Georgia facility. 400,000 vehicles, $3.9 billion worth of operating expenses. That is nearly $10,000 per vehicle in operating expenses. By contrast, General Motors spends about $3,000 per vehicle in operating expenses. The reason this is important is because Rivian has a vertically integrated business model. They are designing their own software. They're designing their own motors. They're designing their own ECUs. They're obviously designing the vehicle itself. And then they're also doing manufacturing. So everything that you're doing internally, everything you're not outsourcing to someone else and leveraging their capabilities, you have to spread those costs across as many vehicles as you make. When you have very small production, you're spreading costs across very few vehicles. When you have a very high level of production, you're a company like GM, Ford, Tesla, you're able to spread those costs across more vehicles. This is one of the reasons that Tesla has been successful financially. They are also vertically integrated in a lot of ways, but they're making almost 2 million vehicles per year, and they only have 4 models, and there's a lot of crossover between those 4 models, not including the Cybertruck. But that's why they can have really good margins, is because those operating expenses get spread across so many vehicles. Rivian doesn't have the ability to make over 60,000 vehicles this year, and even in the best case scenario in 2027, we'll only be able to make about 400,000 vehicles. So those operating expenses are going to still be about $10,000 per vehicle in an absolute best case scenario. When you talk about moving down the cost curve, so if you're bullish on R2 or R3, they're going to sell those vehicles for $45,000 and potentially even less than that. That means that your 25% gross margin, and by the way, no automaker is able to generate a 25% gross margin at scale. One company that is Ferrari, but that's because they are not making hundreds of thousands of vehicles per year. But once you get to scale, at a best case scenario, $40,000 vehicle and a 25% gross margin, you're going to break even. And I think both of those things are too optimistic. Once you start to increase production, those prices are going to start to go down. We saw that with Tesla. We're seeing that across the board with vehicles today, whether it's incentives, whether it's actual direct price reductions. Margins are not going to be that high. I think 15, maybe 20% is going to be optimistic for a company like Rivian long term. And in the meantime, you're burning through all of this cash. So the best hope is that some of these operating expenses go to this Volkswagen joint venture, but keep in mind, that is not finalized. That's not going to be finalized until later this year. And we don't know what the details are. One of the questions that analysts asked when that deal was announced was, is some of your operating expenses going to go into this joint venture? And they basically said, we don't know yet because we're still negotiating the final terms of this deal. So Rivian is in a much tougher position than you might think when you look at their balance sheet, their cash flow, and the potential production that they have line of sight to, which is only 400,000 vehicles. They got a long way to go to get there. And if you don't understand these, and investors need to understand both the costs and the business model that goes into it, because Rivian is trying to be a vertically integrated player, but if they don't have extremely high gross margins or sell a lot of vehicles so that they can spread those operating costs over more and more vehicles, they're going to be in big trouble financially. And I think that's something they're going to have to reckon with. Any disappointment in deliveries, in margins, is going to be absolutely crushed by the market. But let's see. But let me know what you think about Rivian. Leave those thoughts in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.